The benefits and risks of writing covered calls. Writing covered calls is an option strategy that allows the owners of stocks to make additional money from the stocks they own in addition to anticipating a profit from rising stock prices. This strategy has become very popular, so let's examine the benefits and risks of writing covered calls. But first, please take a moment to like our video and subscribe to our channel. All stock market and options market trading involves risk. Carefully weigh the pros and cons of each play before you put any real cash at risk. The benefits of writing covered calls. Number 1. If you buy a stock on the stock market, and that stock does not go up in price, you don't make any money. In fact, if you hold that stock for a very long time, and it doesn't go up in value, you are actually losing money, because that money could have been used to buy a different stock, or be invested in a savings account, money market, certificate of deposit, or mutual fund, where it would have generated at least some growth. If a stock you buy goes down in price a little, then you lose money, and there isn't much you can do to recoup your loss, except to hold on to the stock and hope it eventually goes back up. The only thing you have going for you is that being a stock owner, there are no time constraints. Your loss is only on paper until you actually sell the stock. Using the strategy of writing covered calls, you make money when your stock price goes up and when it goes sideways, not moving much in any direction. If the stock drops a little, you might still make a little profit or break even. If the price drops a lot, the premium you receive for writing the covered call will at least reduce the cost you paid for the stock. For example, if you paid $11 for a stock and received $1 as a premium for writing a covered call, the stock actually only cost you $10. Number 2. Writing a covered call is like buying the stock at a discount. The more covered calls you sell on a stock, trading one every month or two as long as you own the stock, the lower your cost per share. Number 3. Another benefit is that a covered call trade requires very little babysitting. Checking your stock once a day is usually sufficient monitoring to determine if any action on your part is needed, namely buying back the call, buy to close the position, and selling the stock, should the stock begin a major move against you. Number 4. Writing covered calls let you take advantage of the time value erosion of options. The time value part of an option shrinks as the expiration date is approached. This works to your advantage. Your hope is that the stock's price will not rise above the strike price of the option so that on expiration day, the option will expire worthless. You keep your shares of stock in the full premium you received when entering the trade. Number 5. A trader's worst enemies are fear and greed. The plan to write covered calls eliminates much of the emotional pitfalls that arise in other strategies. Once you implement a covered call position, there will usually be no decisions required where emotions could enter into the equation. Writing covered calls will simply require patience, waiting for the expiration date to arrive. Number 6. As the owner of the stock, you collect any dividends the company may pay. If a company issues dividends to stockholders, you can find the ex-dividend date at https://finance.yahoo.com. You can also get a dividend calendar at www.thestreet.com/dividend/index.html. The risks of covered call writing. Although covered calls is one of the safest ways to invest in the options market, there are a few drawbacks to consider. Number 1. Before you can write a covered call, you must own 100 shares of a stock. Unless you have a lot of money available, this is difficult to do on stocks like Facebook and Amazon. There are, however, plenty of stocks whose prices are under $20 a share on which we can write covered calls. Number 2. Another risk is that the price of the underlying stock could drop severely. You can't sell the stock while you hold a covered call on it. Unexpected bad news can cause the value of the stock to drop dramatically. Should this occur, you can buy to close a call option to get out of your obligation to hold on to the stock. Then you are free to sell the stock. You will take a loss by closing the option call because you'll be buying a call at the ask price, which will be more expensive than the bid price premium you were paid when you wrote the covered call. You'll also lose money from the drop in the stock's price. Number 3. Another scenario is that a stock might really start to take off unexpectedly, and you could be making more money from the rise in the stock price than you made on the premium received when you wrote the covered call. In this case, you can consider buying the callback, buy to close, to avoid being called out. Then you will keep your shares of stock. You've got to do the math, though, to see if it's worth it. You may pay another option commission fee, and buying a call at the ask price will undoubtedly be more than you received when you sold the call, as mentioned earlier. This makes the point that you should not write covered calls on stocks that you believe will have an aggressive price increase in the short term. It may be more profitable to simply buy and hold the stock for a short time. Number 4. Market conditions are more favorable to covered call writers when volatility is higher. Covered call writing may not generate as much income during a sideways market, where option premiums will be lower.